Hello, and welcome to today's podcast. Thank you very much for being here. I do appreciate it. Hey, if you like these podcasts, can you please share them and leave a review? I would very much appreciate if you shared them with other people. I have just had a lot of people say that they are helpful, and you know that there are other people listening or other people that want that information. So please share. Okay, today we are going to talk about, are we overpaying on debt? And I have actually had this come up a lot in the last few weeks. And so I thought I have talked about this before in a podcast, and I hate to repeat myself, but I know I've not done something exactly like this. And so those of you that are listening on your podcast app, I am just going to go over the numbers, but I am also going to record this so that we can put this on YouTube and you can actually see the numbers. So I don't always record every single podcast so that you can see my screen, but I am going to do this one, because I really feel that it's important that everybody see this. So if you're listening on your podcast app and you want to see the numbers, go to YouTube and you can find it on there. I have had a few people that I've worked with that have had some credit card debt, or we are overpaying on loans. Today I got a call from a client that said, I'm paying double on my house, or, extra $500 to $600 a month on my house. And why am I doing that? And so a lot of times, not always, but a lot of times I will say, don't overpay on debt. Because could we take that money and put it in a policy so that you have the availability to borrow against it and you have liquidity of it? A lot of times, if we are overpaying on debt, especially a house, if we're overpaying on a mortgage, if we're overpaying on land, if we're overpaying on a piece of equipment, whatever it is we're overpaying on, what's the interest rate? Is the interest rate astronomical that we should be overpaying on it? Do we have money laying somewhere else that if we have a credit card and we're overpaying on the credit card, that might be a great option, right? Well, that's like 20% interest. I don't want to pay 20% interest, so I'm going to overpay on that credit card. I'm not going to put it in a policy. Get it. Totally understand that. However, if we have money sitting in savings, or we have money sitting in an IRA or something like that, do we want, or a stock account? I've actually had a lot of younger people who have had just regular trading accounts that they're doing their own trading. Are you making 20% on your trades? If you're not, why not pay that credit card off and then take that payment and put it to better use? But if we're overpaying on a house, if we're overpaying on land or a piece of equipment that is like 2-3% interest, 4% interest, can we not overpay on that and then take the money and put it someplace that we have liquidity of it? By overpaying on a mortgage, guess what? We just wrap that money up into the mortgage. By overpaying on land, we just wrap that money up into land. Now, we don't want to get ourselves into trouble, so don't get me wrong here. Yes, we want to pay the bank off. Yes, we want to get rid of snakes and dragons. But there are really two thought processes. One, we do exactly what Nelson tells us, and we completely get rid of that loan to the bank. Snakes and dragons, gone. Two, we use the bank to leverage our dollar, right? So if we pay all the land off, if we pay our mortgage off, guess what? We now have to go back to the bank when we need cash and beg and plead and fill out 10 million pages of paperwork to get access to that loan. So can we still get access to that money? Can we pay ourselves, create a pool of money to have liquid? If we need to pay down or pay off the mortgage or the land, we can still do that. It is about liquidity and cash flow. And if we can generate some of that liquidity on our side to give us control, to give us possibilities for opportunities, it is a much bigger deal, right? And why? If you guys have not heard any of Nelson's seminars, you are free to go buy those at infinitebanking.org. You can go to Nelson's website and you can buy his 10-hour course. I would encourage you to do that. He talks about the fact that he had a business partner that needed to be bought out, and he was doing it at a discount. And so what did Nelson do? He walked down to his life insurance company's office, got a check, and 45 minutes later had the guy paid. So he had liquidity. Had he put all of that extra money into his own land, guess what? He would have had to go to the bank, fill out paperwork. It would have been days before it was done. I talked to a client just this morning. He has enough in his policy for a down payment, but now he has to go to the bank and work with them, and it might be a week or two before he can go and get access to that money to buy the land. So we want to have liquidity. Now, let me just break the numbers down a little bit because sometimes it makes more sense. Now, I'm just going to use numbers that I was just talking to a new client, and these are their numbers. So they have $9,700 of credit card debt. And they're paying $350 a month, okay, at 23% interest. That is going to take them 40 months to get that paid off. Well, what if we could say, all right, well, we've also got money sitting in an IRA. What if we could take that money and pay the credit card company off, and then we pay ourselves back? Well, now, and if we charge ourselves 4.76, it's only going to take us 30 months to pay ourselves back. Well, what do we do with that $350 a month then? We can put that into a policy as premium. So for 30 months, we know where the premium's coming from because we were paying ourselves back. But Nelson talks about being an honest banker. What does that mean? Well, you were willing to pay the credit card company 23%. So if we take money out of they have it in savings and they have it in investments, okay? I don't care where they take it out of. I can't tell them which one to take it out of. They get to do what they want. Should they take it out of savings? Should they take it out of investment? I don't really care. If they are going to be honest, they must pay themselves back. So now we need to pay ourselves back $350 a month for 40 months at 23% because we were willing to give the credit card company 23%. Why aren't we willing to give ourselves 23%? Now we have 40 months. Well, you guys can see in 40 months, they have collected $4,277 of interest. $4,200 of interest is going to go back where? Into the policy as premium if they pay the policy back. If they decide to pay their savings account back at 23%, well, great. Now we have $4,277 of extra money in our savings account. I really don't care where you put it. It doesn't matter to me. But what if we paid it back? What if we paid that $9,700 back at 4.76 over 30 months? Guess what? That's $598. So about $600 of interest. That is huge, huge, huge. That is a huge difference. Be honest. You were willing to pay somebody else. Is that money in savings making you 23%? Nope. Is the money in an investment making you 23%? Nope. Could you make 23% on either one of those pools of money if you just used it to pay off this credit card and pay yourself back. Yep. What's the risk? What's the risk? That you're not going to pay yourself back because you don't value yourself as you do the credit card company or the bank. Right? Now, let's look and say, what if I did a 15-year mortgage versus a 30-year mortgage? Now, this is a big deal because nobody wants to do a 30, okay? If we buy a $300,000 property at, let's just say interest rates not right now are super low at 4%. So, well, they're actually lower than that. They're like 3.5. Let's say we're going to buy at 3.5% over 180 months versus a $300,000 mortgage at 3.5% over 360 months. Okay, again, if you want to see these numbers, they're on YouTube. So if we did that for 360 months versus 180, if we do a 15-year mortgage, our payment is $2,144 a month. If we do a 30-year mortgage, our payment is $1,347 a month. Now, what if all we did was take the difference in those payments and put it in a savings account or put it in a policy? And what if that policy earned us 4%? Okay, what are we looking at? Well, we're looking at a savings of about $790 a month. $790, where is that money going to go? In your pocket every month. Otherwise, you're giving it to who? The bank. And when you need to access that money, guess what? You get to go refinance. You get the fees, you get to pay for the appraisal, you get to fill out the paperwork, you get to give your firstborn child, right? It's just not that easy to get access to it. But what if we put it into a policy? And what if that policy earned us a 4% rate? Well, if we go down and look at year 15, if we did it the old-fashioned way, right? And we just gave all that money to the bank, we would be done. 15 years, I'm done. Then I can start a policy, Mary Jo. Okay, great. But if you did it the 30-year way and you paid a mortgage for 30 years, in 15 years, you would still owe about $190,000 to the bank for your house. Wouldn't be paid off. You'd still owe $190,000. Cash value in your policy would be like $196,000. If you truly hated the bank, could you borrow from your cash value to pay off your mortgage? You sure could, all day long. And then you could just keep making the payment back to yourself, right? If you did that, what would happen? For 15 years, you would have liquidity of money. So for 15 years, you would be able to access money and cash value. You'd be able to put braces on the kids. You'd be able to buy cows and pay them back. You'd be able to buy a piece of equipment and pay it back. You'd be able to maybe put a down payment on land and pay it back, right? All those things you could do over 15 years that you are not doing right now because you're just putting all that extra money to pay down other expenses. And then you're saying, hey, Mary Jo, when I get those paid off, I can start a policy. Sometimes, yes, that is a true fact. We have to get those paid off to start a policy, but not always. And so how do we know when it is right to start a policy and to wait? Meet with me. Right? The couple that I met with this morning, she's like, I can't start a policy. I have all these bills. I'm like, well, we don't know that. Right? And after we determined several different avenues of where we can start, guess what? We will basically, if they can use money from a savings account, they can pay that off. And they may be able to start 2 policies. We maybe want to wait another 12 months, 18 months until some of her other stuff is paid off. But ultimately, it wasn't as cut and dry as she had thought. Oh, I have these expenses, I have to wait. Nope, not necessarily. Because we don't think about money correctly. We say, let's wait to start a policy until we have cash. You are never going to have cash. Never. Because you will always find something else to spend it on. Unless you can beat Parkinson's law. And if you don't know what Parkinson's law is, I encourage you to go back to the podcast on Parkinson's law. Unless we can beat Parkinson's law, we will always spend any extra money that we have. And so if we're going to take the difference of $790 a month, and we're going to put it into a policy, what happens after 30 years? Okay, we're done, Mary Jo. That was the deal. 30 years of $790 a month, and we're done. Really? Or are you going to continue to be honest and say, well, I haven't missed that $790 for 30 years. Why would I miss it now? I may as well keep making that premium payment. I may as well start another policy with it. So there is a big picture here. Moral of the story, liquidity and control of money can sometimes be beneficial over paying something off early and building equity into something that you might not ever want to sell. Right? Another thing to think about is if you owe $100,000 on a house or $50,000 on a house, the bank is going to be much harder to work with because they can go put that house on sale. Right? They're going to make money. It's going to sell. They don't have to get top dollar out of it. But if you owe a lot on a house, guess what? They're going to be less likely to foreclose. Not that that is a reason to do it, but the banks are going to work with you if you owe more than owe less. We have a house right now that is for sale locally, and they have, it's gone into foreclosure. Chances are that house is not, the banks are willing to work with those people because they're like at 1.3 million for sale. Right? So we have to make sure that the bank's going to be easy to work with. They're not going to kick them out. Okay? So that not always does it pay to be paying that off. Not always. I'm trying to think of some other scenarios because we don't always want to have this debt either. And sometimes it makes sense to do a debt snowball. Sometimes it doesn't make sense to start a policy, and it makes more sense to do a debt snowball. So let's do the debt snowball, and then I'll start that. But I'm going to tell you that in the meeting. I'm not going to automatically say, oh, no, this is the only way to do it, because it's not. And then there are people that absolutely do not want the banks in any portion of what they do. And so if we don't want the banks in anything that we do, who cares if we have that house paid off and we have the equity in that house? Because that's essentially what Nelson is telling us in the infinite banking concept is get rid of the snakes and dragons. Do not ever use their money, period, because then they turn it and we have fractional reserve banking. Yes, I agree, right? If we want, there's a time and a place for each. I do not like the banks. If I can private fund it or use private lending, I will do that before I go to the banks. But if I am in a position where I am trying to build liquidity and I'm trying to create the cash flow so I can take advantage of some opportunity that comes up, I may use the bank for a while to do that. It is up to you. I have clients that absolutely 100% hate the bank. They have completely paid everything off. They have borrowed it from their life insurance policy and paid off the bank. They're paying higher interest to the life insurance company, but they don't care because A, it's their company, it's mutual. Guess what? They're getting a dividend. They're supporting their own bank. They're doing exactly what Nelson said. But they might not be the person that wants to leverage a dollar. They might not be the person that's looking for an investment. Okay, we are all at different places of what we're going to be doing. So I hope that helps. I know it actually might be more confusing, but I hope that helps you understand it is not always better to do a 15-year mortgage. If you want to pay it off early, you can. If you want to pay land off early, you can. If you want to pay a pickup off early, you can. But if you do a lower payment, you have more cash flow to put someplace else. And I know that I have talked about this before under where to find money, right? But I really wanted to go over some of the numbers, and this isn't breaking it down like to the nitty-gritty, but this is breaking it down enough that you are going to understand liquidity and cash flow are super, super important. And you guys, if you are not joining me on my Thursday night Facebook Lives, you probably should be. Thursday night, 8:30 p.m. Central Standard Time, every Thursday night, I go over all the meetings I've had with clients for the week. And twice now, it has come up that I have a couple of clients that are big Dave Ramsey fans. Love them. Absolutely love them. Doesn't matter who they like, right? But they have both been in a position where they're stuck. They don't have the money. And why? Because they are overpaying on debt and have no cash flow. Debt that doesn't necessarily need to be overpaid on. Credit cards that could get moved to a 0% card with a small fee to do that for a transfer. Money that they're sticking into 401ks and IRAs that doesn't need to go there. It is all about cash flow. They could not grow their operation because they were trying to pay off debt and wait until they were debt-free. Debt-free does not create cash flow. If we can put money somewhere that creates cash flow, why are we not putting our money there? Dave doesn't know crap about farming. And I have had several farmers tell me that. We love the fact that Dave helps us manage our money, but that does not help us grow. It doesn't help us buy animals. It doesn't help us buy equipment. Yes, we have it paid for, and that's fantastic. But are we creating cash flow? We need to create cash flow. Because I've said it before and I'll say it again. The homeless guy on the street is debt-free as well. But every day he gets up to work for that money. If we can use some of that, if we can redirect those dollars to create cash flow to pay the bills, is that not what we want to do? We have heard about it our whole entire life, but very few people are actually telling us how to create the cash flow, and very few people are telling us what to do with the cash flow to create wealth, right? This is a tool that creates wealth and a concept to help you think about how to use that wealth and how to use those dollars coming into your pocket. Nobody is telling us that either. Just live below your means, live below your means. Okay, great. How do I increase my means? Those are the things that we need to look at. Okay, that's it. That's all I have on this subject. If you want to hear more, please, please, please email me, maryjo@fiscalbridge.com, or I'm sorry, wrong email address. Don't email me there. maryjo@withoutthebank.com, and I will get back to you. Happy to answer any questions, any podcast topics. Fantastic. Let me know what you guys want to hear. Otherwise, I am just doing podcasts based on lots of things that I'm seeing every week. Do tune in to the Facebook Live, 8:30 Central Standard Time, Thursday evenings, so that you can hear kind of what everybody's doing and how we're finding money. And, is it just big farmers? Is it urban farmers? It's everybody. It's everybody and non-farmers. You don't have to be a farmer in order to utilize the concept. Okay. The people that I meet with, a lot of people that are just getting started, and we go over all of those things. So tune in to that on Thursday nights. If you've not gotten the book, farmingwithoutthebank.com, go to the store, grab the book. If you've not gotten Nelson's book, Becoming Your Own Banker, why not? farmingwithoutthebank.com. You can go there, you can get it in a packet or you can get it in a bundle. You can get my book and you can get Nelson's book and you can get an audio of both of mine. Okay? All right, you guys, that's it. That's all I got today. So let me know if there's anything that I can do. Grab the books, schedule your appointment. I'm still booking out till the middle of October. So get your appointment scheduled so that you get on the calendar and get that book read in the meantime. All right. Have a fantastic day, and we will talk to you soon.